It is true that equity hedge funds really do, from a risk-adjusted point of view, properly measured, we get into that if you want to, it really is true that hedge funds on the whole, on a risk-adjusted basis, properly measured, do outperform mutual funds. And that shocked me. But when I just did read stuff and looked at stuff and measured stuff, I found that was true. And so I want to get that point in. I can describe what I think it is, but right now, okay. All right. There's you're familiar with target volatility. A fancy way of saying that is intertemporal risk parity. I love using that phrase because that's no intuition.
That's very easy. Target volatility is size your investment. If the market is more volatile, then you reduce your investments. Less volatile, you increase your investment to try to keep the volatility constant.
In other words, you want your volatility of your portfolio constant. And by the way, I'm not even sure why you would do that outside of the equity world, other than you want to just manage your volatility. So I can understand that. But there is a market where when you do that, it outperforms not doing that. And there have been studies going back. There have been lots of studies over lots of markets, and it kind of blows your mind. But if you do what's called target volatility, or try to maintain volatility of the portfolio, which means it's not unlike what portfolio insurance, except the magnitude of it relative to the size of the investment is minuscule. But when you say you want to maintain a 15% constant vol in the S&P 500, that will outperform on a Sharpe ratio perspective, legitimately calculated Sharpe ratio perspective, tails and return over drawdown, the whole thing. It will outperform over the last 15 years, over the last 30 years, over the last 80 years.